Okay, let's answer some questions from the last market outlook. We had Monday off. We had a pretty red Tuesday, which I took advantage of lightly because I naturally thought we'd get follow through for Wednesday, and I don't know what's going on with this market. It refuses to follow through on anything. So here I am waiting. Let's begin. Very glad that you moved market positions to the paid website. I've already derived a lot of value from the added details in your explanations. So let me say a word about new positions and exactly what function they're supposed to serve. They are not recommendations. I am not by any means suggesting that you should go out and buy these things at all. What I'm doing is I'm showing you my thought process in how I do things. I have a very particular strategy. Is I look for value or deep value. I look for something that is undervalued because I want to buy low and sell high. I'm not a momentum chaser. I don't buy high and sell even higher. I look for value, specifically deep value. It's got to have a dividend yield and it has to have options. If these are present and I've got something that is undervalued, I'm all in. That is my style. You may have a different style, or you may decide that, these are boring stocks that I'm looking at and you're not interested in. That's fine. I'm not by any means saying, hey, look you got to buy this stuff. I'm just saying, here's how I do things. Here's my style. And I think for credibility, I should tell you in advance what I'm doing and let the record speak for itself, right? But yeah, when I put them up, the positions I put up will have more detail around what my thesis is, as opposed to saying I'm doing this, I'm doing that. It'll lay out how I think about things and what strategy I'll be using. Would you consider doing an update to your Ice Age is Far From Over video? I don't know. I don't know that anything has changed on that. I still believe in the title, the Ice Age is far from over. And what we're finding is that pure EV is not as exciting as hybrid, which in that video I said that is the pathway. That hybrid makes a hell of a lot more sense than pure EV, given the carbon footprint and given all of the problems with pure EV that a hybrid would solve. Hybrids will go 40 to 50 miles a day on just the battery. So if you're just commuting in town and then back home again at night, if you're driving 40, 50 miles, you can go months and months and months without ever hitting that gas tank. Isn't that the point? Right? So I think we're seeing more, at least in 2024, that hybrid has outsold as a category. Its growth rate, I shouldn't say outsold, its growth rate is greater than the growth rate in EV. Given the recent boom in EV production in China, comment on the importance of semiconductors and the pace of ICE to EV transition. Well, it will require more chips. An EV will require more chips because you have a battery, and that battery can be software managed, whereas an internal combustion engine simply just burns fuel. So you will need more chips. The big boom in chips comes with AV, autonomous vehicles, which we're seeing more and more and more of. There are some, I believe, 50, 60 robo-taxi businesses across the world in different countries, in different cities. 50 to 60 of them already. And I don't think that will slow down. I think that will become a crowded space. I don't know who the winner there will be, but chips will be the winner. A couple happy birthdays here. Thank you for that. Listen, Ed Yardini, Permabull, probably you mentioned it too, who said that every recession before started due to a credit crunch following the curve inversion. Well, the quickest way to a recession is a credit crunch. That is the quickest way to a recession. That did not happen in 2001. It was not a credit crunch that did that. It did not look in 2019 that was going to be the case either. And the economy was slowing down, and there was a belief that a recession probably was looming, but then you had COVID, which really did a lot, and then you had a lot of governments push a lot of money into the economy, which probably forestalled that recession, but that didn't look like it was going to be caused with credit. It's hard to pull that apart because once you get into a recession, credit tends to pull back, thereby almost making it inevitable that it will be a downturn. So there are credit crises which lead to downturns, and there are downturns which lead to credit crises. In a downturn, a lot of credit dries up. This could be because something broke as a result of the lagged effect of the rate hike cycle, but the Fed had not discovered QE, or was wise not to use such measures. I don't understand that. What point you're making there? Had not discovered QE. That's not my experience. They're very versed in QE. Is it possible that, recession or not, we will not see a sustained drawdown in the indices ever again? Well, no. No, since the Fed stands ready to rein in with impunity and flood the markets with... Well, no, that is one line of thinking, to say that the Fed is there to protect the markets. They're not there to protect the markets. If there is a liquidity crisis and a credit crunch, the Fed will step in to solve that. In solving that, it may boost asset prices, but they're never going to say, oh my God, the S&P's down 6% from the top, let's step in and push it back up. They're not in the business of pushing up markets. Their actions will inadvertently push up markets sometimes, but they're not in the business of pushing up markets. I wonder if Bernanke introduced QE in 2009 as a stopgap measure to rescue the economy, but the Fed has continued to abuse it since then. I think they carried it on for far too long. I think they kept talking about the recovery, 2014, 15, 16, 17, the recovery. Oof. We were way past recovery. If you think of a business cycle, where this is the expansion, there's the slowdown, there's the contraction, here's the expansion. That's the recovery phase. Once you exceed the last high on GDP, you're in the expansion phase. Recovery is over. Recovery was long over, even though they kept using the words the recovery. It was long over. But sometimes you need cover to be able to do what you want to do. If this is the status quo, can one just buy TQQQ? No, and sit pat? No. Yeah, I think you're looking for an easy way out here. There is no easy way out. No, absolutely not. Chinese domestic demand under massive stress. Reluctance of the government towards fiscal stimulus and debt relief programs for local governments. There's risk that we could run into risk of plunging commodity prices. True, iron ore is already there. Iron ore is down about 30% since the beginning of the year. And you go to China, there are big stockpiles of iron ore. China accounts for about 60% of total demand for most major commodities. For copper, steel, aluminum, coal, 20% of crude. Do you think of a Chinese weakness materials? You can see the commodity plunge. Chinese weakness is here. It's not that if we see it materialize, it is here. And here's where we are. It is here. So I don't know, when we think about weaker, I think the property sector is already under a lot of pressure. The consumer is under pressure. You have the reluctance of governments to use the debt levers even more. This is the weakness. If you have investors calling for government stimulus, that means you're in the weakness. So here we are. We're already here. I shorted the 97 put December 24 TLT. We'll see. Well, it has been a winner this week. When you say it'll run 12 to 16 weeks, this is the financial modeling course. Do you mean videos will be gradually added over the course of 12 to 16 weeks? That's exactly what I mean. It does take time to make these things. They don't just come together. It takes a lot of time. What I could put the whole thing up. I could just do the whole thing and wait till like mid-October and put it all up and say, here you are. But there will be questions from week to week to week. So as I put it up, I'll get questions, and I may say, oh, well, that's a good thought. Let me incorporate that into the next thing we do. Somebody says there's an easier way to program that in the cell, just use this command, and I may look it up and go, oh yeah, you're right, because I'm not an Excel expert. I get by. I'm pretty good at Excel, but I'm not an expert. So I want to be able to incorporate these things from week to week. So yeah, it'll run over 12 to 16 weeks, yes. Is Excel side of the course presented separately? Would it all be in one video? That I'm debating. I can put, week 1 up and off it goes, or I could say week 1 and we'll do the financial stuff with Costco. And then we'll go to Excel and say, okay, how do we model this in Excel? Because it is financial modeling, with the financial part, in my opinion, being the bigger part. I mean, you can model growth rates. You can say, 2015 revenue was a certain number, 2020 revenue was another number. Let me calculate a growth rate and forecast that out. That's going to get you nowhere in understanding the business. That's going to get you nowhere. But we could easily show you how to model in Excel using the same commands and doing the same thing with naive growth rates. But it's not going to be of any value at all. This is the big thing, the financial part. The modeling is second. So I guess I could do 2 videos. One with Costco where we make all our assumptions and we get our algorithm down. Our algorithm means revenue equals, and then we have certain variables on the income statement or certain assumptions that we're making, or certain drivers that we have that equal our revenue or our revenue growth rate more likely. And then go to Excel and say, okay, let's start modeling that. That probably would make sense to do it in two separate videos. So yeah, I probably can do it in 2 separate videos. What I think we're going to do is we're going to do Costco first, and then we're going to do CAPREIT. It's going to be, I think, a little overwhelming to try to do 2 at the same time. So we're going to focus on one first, and then when we get to the other one, the Excel part should be pretty straightforward because it would be the same Excel that we've done here and would have most of the model built. Well, would have the engine built. We just have to put in new numbers, so it'll probably be sequential. When applying for a job, you recommend showing a financial model we've built. Yes. Do you mean a printed version or Excel file? You can bring both. I suppose they might want to have a look at how the model is actually constructed, which functions, etc. I think so. I think nothing speaks volumes other than showing something. You can always say, look, I've taken this course, I've done this, I've done that, but universities pump out a lot of graduates who haven't got a clue what they're doing. So just putting a BA on your resume doesn't mean you even know what you're doing. Nothing says I know what I'm doing than demonstrating, opening your laptop, spinning it around, say, I did this, I built that from scratch. Right? So, yeah. Think of reasons why curve flattening while rate reducing cycle usually precedes a recession. Well, now we have to be careful here. When we say it usually precedes a recession, the most popular form of inflation is demand-driven inflation. And rate cutting cycles precede a recession because rates are cut after inflation is killed. But after inflation is killed usually means you have to kill demand. And there is momentum behind killing demand, which they start seeing a little later on, saying, uh-oh, we better cut. But usually the momentum on the drop in demand is well underway, and the cutting really doesn't avoid the inevitable, which is the recession. This round has been supply driven, and supply is healed. The higher rates didn't do a lot to kill demand because even though you killed some demand, demand was still greater than the supply that existed at that time. This is a little bit different when you have supply-driven inflation. The rules can kind of get really funky and messed up. The models are messed up because the models are typically built for demand-driven inflation, and that works very well. Oh, we had supply-driven inflation, so, kind of all bets are off on this one in terms of looking at history. The easy scenario is if something naturally breaks in the economy, then recession has happened due to the prolonged high level of rates and Fed will aggressively cut. True. Other scenario, prolonged high rates have not yet caused a recession. Capital sees the economy would likely perform at the long-term average growth rate, and current long end of the curve is more attractive lock-in. They rush to it. Reducing liquidity that could otherwise be deployed in the economy and reduce liquidity exposes the fragility of the system. Oh, so you mean that more money goes into debt at the long end of the curve and not enough money goes into actual investment in the economy? Debt is usually issued for investment in the economy. So if money is rushing into corporate debt, let's say investment grade corporate debt, 10 to 15 years, it's corporations raising money to make investments. I don't know that I would use the captive, that money is captive in those markets. I don't know if I would use that theory. I missed a grandfathered for new positions. Since July 31st, that was the cutoff, right? August 1st, new subscribers got the applied level and everything that goes in the applied level, but not the new modules. New positions was a new module. Since then, I've gotten some emails from subscribers saying, I was unaware that there was even a deadline. I naturally assume that if you're interested in what I do, you're on YouTube. And I think that is my best way of communicating is through YouTube. It did not occur to me that there would have been people in the mm.com family who were interested in the applied level but do not watch any of the YouTube things that I do. It didn't really occur to me that way. So I thought, well, okay, fair's fair. You didn't know about the deadline, and it was my oversight. I didn't even think about it. So I'm going to extend it to September 30th. So everybody in the mm.com family, all past and current subscribers, and it's a big number, is going to get an email on or about September 10th, extending that deadline to September 30th. So if you miss the deadline, you'll get extended. Problem is, we had some of them throughout here. What do we do with those? How do we tear that apart? How do we determine who's who? Well, we could easily do an email search on all of that and siphon it out, but it seems that if I'm going to extend it to September 30th, I should do it for everyone. So anybody who bought after July 31st, once we get to on or about September 10th, you will notice that new position shows up in your account, and we will extend the deadline to September 30th at this point. But the extension, really, the offer is going out to mm.com subscribers. I'm just automatically going to upgrade everybody over this period of time. So yeah, if you have the subscription after August 1st, I'm not going to make a distinction of, oh, you've never been an MM subscriber, too bad. It's just going to be easier just to upgrade everyone. But this time, September 30th is a hard stop. It's a hard stop at that point. Doesn't really affect too much. I do have to change some start dates of some other things because I've already been in conversation with some people for modules that they're going to add on. So it is going to delay everything by 60 days. But, you got to roll with the punches, right? You make a mistake, you got to own it. My mistake was assuming that everybody in this group who was interested was with me on YouTube. In the applied level new positions, wondering if it would be possible to provide updates on your position changes in the middle of the week as well. I really don't want to do that. I got to be careful what I'm doing here, right? What I'm putting out is my thought process. Here's what I'm doing and here's why I'm doing it. Here's what I look at. If I start putting things out in the middle of the week or tweeting out position changes live as they happen, I attract attention. Attention I don't want. Attention I don't necessarily really care to have. Is that why am I doing this? Am I doing this for education or am I doing this for influence? If I'm doing it for influence, I get a whole bunch of eyes on me. Eyes that I really don't want. And then if it's deemed that I do have influence, I get a whole bunch of requirements put on me at the same time. So the positions I put up each week is really about, here's how I think about the position, here's how I think about the market, and here's how I'm going to approach it. Here's how I'm going to use options. Here's how I'm going to build an allocation. Here's how I'm going to get an income boost on this. Here's the risk of what I'm doing. But I don't want it to be in any way a real-time, follow me online trading strategy at all. I gotta be careful that I'm not doing that. So for number one, I'm going to have to say firmly no. I would not entertain that. I wouldn't entertain that. Besides, on the positions, I do say what I'm going to do during the week. If I see this, I'll do this. If I see any material weakness in these names, I will certainly sell puts. I think I said if I see any weakness in some of the names, particularly one was on, I did sell 70 puts and I did sell 65 puts because it really had a pullback. SOXX is something I'd be looking at the 180 put level as well. And depending on where NVIDIA falls out, I think it's got more weakness. But I do say ahead of time what I would be looking at doing. And I do those things. Given Goldman Sachs cuts copper price forecast, did your views on copper and copper companies change? Or do you see Freeport bottoming out as an opportunity to buy more? So let's just do a timeline and let's go out 5 years and let's go out 1 year. This is, I'll draw a funny looking cloud with some rain, right? It means the forecast is cloudy. I don't know in the next year what to expect, but it's a winner over 5 years. It's definitely a winner because any new investment in energy production predominantly is going into green energy production. Which means you need battery packs, which means you need even more copper than you would think you would need because you need all the copper in the battery packs, you need all the copper in the green energy production, more so than you would in traditional carbon-based. And then you got to move those electrons to the grid somehow. You need even more copper. As rates come down, I think you're going to see housing booms in the US and in Canada because there is a shortage of housing and high rates have kept that down for a long time. Houses take a lot of copper. There is not, and EV will continue on, hybrid will continue on, AV will continue on. The world will get more digital, which means you've got to send things along, you've got to send bits and bytes and electrons along things. Anything digital needs to be charged. You need a battery. Anytime electrons are involved, you need copper. So there will be more need for copper going forward, not less. There will be more need. So it's a longer term play that I feel fairly good on. Over the next year, I don't know. But what I would like is I'd like to see Freeport come down to maybe the 34 to 36 range so I can collect more and use the options. I don't necessarily need to get into something and have it go straight up. If you're just a buyer or seller, you buy, you sell, you buy, you sell. You buy something, you basically want it to go up. You don't want it to do this first and then go up. You want it to just go up. I don't mind this because this allows me to allocate because I want a bigger position. My goal is here. And by judiciously using the calls and the puts, I can inoculate myself or immunize myself from a lot of the risk of the short-term risk. So I'm not too concerned about it. Again, it's my style. It may not be your style. So if you're concerned about copper, you may want to avoid it. But I'm more than happy to be in it for the next 5 years. And with gold prices this high, I like Freeport because they produce a lot of gold. So I will continue on with this. As far as the cutting of the copper price in the near term, yeah, I would probably say so. When it was pushing 5 and 520, if you go back in the videos, I clearly was saying this is too much. It's gone way too far than it normally should. I expected to retrace back to the 4 to 425 range, which it did. I don't expect it to break much below like 380. I hear some calls for $3. If there was going to be $3, it would have happened because there was much more material weakness and oversupply a year ago in the copper market, and copper held firm at around 360, 365. So I think the floor is in on copper on that point, but it's not ready for $5 yet. It's still, I think, a $4 to $4.25 commodity. Which gives a nice opportunity to allocate. You give me a nice stock with dividends and options that's doing this. that's going sideways, I can do very well on that. I can do very well on that. So I'm not concerned because based on my trading style, a sideways stock to me is just as profitable as an upward moving stock. On which comparison you pay more attention to in economic data, the previous to actual or forecast to actual? The previous to me seems more important than the forecast, because forecasters can be wrong, but the previous reading was a reading. So let's say that I am losing, I'm on a diet and I'm losing weight and I weigh in, I'm 230 pounds, and based on what I'm doing, some people watch and say, we forecast you to be 225, and I weigh in at 226. I've still lost 4 pounds. And then I keep going, and the forecast is, you'll be 220 in no time, and I weigh in at 222. I'm still losing weight. Look at, see? Whereas this is just everybody's best guess. The average of all the best guesses, which can be influenced by a lot of behavioral biases. But the previous reading is the previous reading. So you can, if you're looking at historical data, you're not looking at all the forecasts, you're looking at all the actual and the revised to the actual to get the trend. I think that's more important. If you hear some dinging in behind me, that is Apple that feels the need to let me know on every device every time I get any kind of notice. Personally feel the actual to previous is far more important. There we go. Particularly in the long run for instant reaction. It seems that often the comparison to forecast makes you instant move. That is true. Same with earnings too. But in the long run, who cares what the forecast number was X months ago? You're right with me. You're right with me. Or I'm right with you, I should say. Any potential legal implications of you disclosing your positions? Oh, look at that. Obviously, you're not telling the honest to copy you, but you're a highly respected figure. And if someone does copy a trade that happens to go south, I wonder if you could face litigation. It would be difficult. It would be difficult, I think, because I've said on many occasions, do not copy me. You don't know what else I'm doing, and this may not be appropriate for you. I don't manage anybody's money. It would be the same as listening to Kramer and losing money, which you will. He's about 50% right, which is a coin toss. You couldn't sue Kramer. Right, it would be difficult to make a case that I was responsible for anything when you are a level 2 or level 3 CFA candidate, or you have a master's in finance or a background in finance. The vast majority of applied level subscribers are in the CFA family. It would be hard to say I'm an expert in training and I don't know what I'm doing. It would be hard, and again, because this is digital, it's video. In many places, over many years, I have repeated the words, do not copy me. I've said many times, I'm doing this to show you how I think. So, no. If I started, as the person earlier suggested, can I do my trades live, and the moment they happen, yeah, that's going to be a problem. That's going to be a big problem. If I were doing penny stocks, like 1 cent, and I was on YouTube promoting these and saying all sorts of wonderful things about them and then selling them when they got to 3 cents, if I had a history of that's pump and dump. That's wrong. I'd be fried right away. But it would be hard to convince anybody that I'm moving any names as big as AT&T, Bell Canada, GM, Freeport. They're simply just too big for me to have any influence. So it would be hard to demonstrate that I have influence. And as far as a losing position, I have said many times, do not copy me. Unless you agree and you know what you're doing, stay away. The AI hype is done. I'm calling it. Once people realize there will be stagnation or sell-off with NVIDIA and other AI players. I don't think the AI hype is done. I think the AI hype is moderating, but I don't think it's done. CFA Level 2, Canada, subscribe to your CFA material and applied level. Junior analyst on the work side of things. Having worked as a PE analyst, corporate development analyst, I have only worked in private markets, never traded any publicly listed securities or analyzed any. So I want to make the career jump to the public markets. How would you recommend I use the applied level in CFA to prep myself to achieve that goal? What daily habits should I develop in terms of following market news and data? Well, it's a game. This is a beautiful, beautiful game that we play. And like any game, you got to play it. And think about any game you play, any role-playing game you play. There are certain stats you get, right? Hit points, magic points, health, endurance. You look for treasure, you look for gold. That's the same with the market. The more education you have, the more spell points you have, right? The more you learn risk management techniques using options, the more hit points you have, meaning that you can endure a market downturn. And since you've used options judiciously, you're kind of not completely protected, but it's not as bad as it would be. The more you learn how to read 10Ks, the more you start uncovering all your assumptions about how a company can grow, the more gold you'll find. Opportunity is everywhere. It is everywhere. I can't even begin to tell you. It's everywhere if you have a prepared mind. So you think about this as one big giant role-playing game. I don't have to tell you how to play a game, right? Question 2. You previously talked about switching from being employed to managing your own money, and I aim to do that at some point. You said you used to work very long hours while being employed. I don't think I ever said that. I've never been employed. When I was building my business, yes, super long hours. It's all consuming. It's everything. To get a feel for what it's like managing your own money, how many hours do you put in daily? Oh, I can't answer that. It would be, I want you to think about it this way. Let's say a very accomplished musician writes a song and you say, well, how many hours did you put in? What will the musician say? 6 hours? But that wouldn't be true. The musician has put in thousands and thousands of hours to get to the point where they can only put in 6 hours. So how many hours a day do I put in is no measure of how many hours a day you would have to put in. In the beginning, you're putting in a whole bunch of time because you got to pay your dues and build your knowledge. Now, when I look at something, I pretty much know what I'm looking for. And if something's bad, I can pretty much spot it very quickly. You start reading a 10K, you get to a point, you go, no, I know I'm not interested in this one now. Or, okay, I'm interested in this one, right? The amount of hours I put in is not reflective of the actual amount of hours you'd have to put in. It's built on a mountain of thousands and thousands and thousands of hours and years of experience. So the hours I put in is a function of everything I've already done. And if you haven't, then there is no answer for how many hours you're going to have to put in. The more experience you have, the longer you do things, the easier you'll make it look. And then everyone will think it's easy because, heck, it only took you 3 hours to do that. Yeah, but it took me 20 years to get to the point where it only takes me 3 hours to do that. So I cannot answer that one with any decent answer. But at this point in my life, how many hours do I put in? All week long. I never stop thinking about it. You can't turn it off. Every story you read, you're reading through the lens of the market. Every video you do, when I do the market outlook, it's the market. Any sector studies video I do, I learn more about a sector, a subsector, a company. It's the market. Everything happens through the lens of the market. Right? Everything is through the lens of the market. During a market sell-off, how do you determine when to sell puts as a volatility play versus a directional bet for building an allocation? They're kind of one and the same thing, right? So for an allocation, I may say, look, I'm comfortable with 20,000 shares on something. But if volatility is spiked really high, it never really stays there. Your underlying has fallen a lot. That usually recovers fairly quickly. I'll get even more aggressive because I know they won't be put to me, or I have a very good feeling that they're probably not going to be put to me, and I'm there for the volatility. But with yesterday's sell-off, implied volatility went up 2.5 points. Hardly anything to talk about. That wasn't a day to sell volatility. That was a day to think about, well, directionally, what do I want? I see this thing pulling back. Let me sell some puts there because I don't mind if they're put to me. I see this thing pulling back. Let me sell some puts there. Just experience, I guess, over time. For example, on Freeport's 6.5% pullback, I sold October puts. We considered selling January puts due to their higher Vega, although IV was not that high and there was no significant volatility skew change on FCX. What factors should I consider when deciding which month's contract to sell and when? So, copper fell for its own reasons because the Goldman Sachs report that downgraded the price of copper from 15,000 a ton to 10,000 a ton. So it had its own reason. That doesn't end in one day. For those kind of things, you got to be a little bit cautious because you have somebody and an investment bank advising all their clients that now's the time to leave copper. So that doesn't just end in one day. So you want to be slow on the way in. But let's say that there was an event on the other side of the world and it caused a lot of panic and markets were down big time. But so was everything. It had nothing to do with copper in particular. There is where I'd be more aggressive. But this was something particular to copper. It's going to take some time for the market to figure out, well, what do you want to do about it? Does the market believe it? Does it not believe it? So there you be a little bit more cautious. I did sell $40 puts, but that's about all I did do. I don't mind owning FCX an effective price of 40, but I realize I may have overreacted myself by selling 120 put contract. Ooh, in total at strike of 42, 43, 44, and FCX drop resulting in 400,000. Ooh. Oh, your experimental portfolio. Okay. Ooh. Okay, so it's your experimental portfolio. If you're going to make a big mistake, that's the place to make it. How can I determine the optimal quantity of puts to sell without taking on excessive risk? Well, I've said this before. If you're take your portfolio, multiply by 0.001, and watch the theta on the options, and make sure that the theta is less than all the sum of all the thetas is less than 0.001. And when you're comfortable running short puts at that level, you can move it to 0.002. That's a nice way to size it using some endogenous variables to the option, which is theta. What criteria or tools can I use? Okay, just did that. Where is Freeport today? 41.74. So depending on when you sold your puts, you might actually have made some money today. Well, in your experimental portfolio, you made some experimental money. Some Bitcoin. There you go. Would you please be able to elaborate on how you came up with 200 cut in the 1 year? I know you explained it, didn't quite understand. It's very simple. Let's just take an example of a 1 year security that has a 2% yield, and halfway through we expect 50 basis points of cut, so it'll have a 1.5% yield for the balance of the term. So for 50% of the time, it has a 2% yield, and then for 50% of the time, it has a 1.5% yield, giving it a 1.875% weighted yield. So this yield, the yield on this security, which would have 2% up to this time and 1.5% up to this time, you would be indifferent between this versus a 1 year security that paid 1.875% consistently. That is pricing in 50 basis points of cuts. Notice that it is 12.5% lower than where this is. You just double it, and there's the number of cuts you get. If you expect it to be, uniform over the period of time, well, over a 1 year period, you have fairly uniform Fed meetings, and you have an effective federal funds rate of 5.33. If we expected no interest rate cuts over that period of time, the 1 year would be at 5.33, but it's at 4.38. which is about 100 basis points lower. Again, this 1.875 is 12.5 lower than the 2 because of a 50 basis point cut. So take the 100, multiply by 2, There's 200 basis points. If you look at Fed funds futures, they're pricing in 190 basis points. Right? So it is in the 1 year. Curious to get your views on overall liquidity and the potential for increased inflows into equity markets. Based on my understanding of the changes in the Fed's balance sheet since QT, bank reserves have increased. I'd say they're more flat. I don't know that they've increased. While tapering has only impacted RRP. It's going to impact the RRP first. Always. That has to run off first before it hits reserves. Think about it like a pool that's overflowing. You first must get it to the right level before you affect the level in the pool. You first have to, get rid of the overflow as you're emptying out the pool. The overflow gets hit first. The RRP was the overflow. Reductions in RRP would appear to go directly into T-bills. No, not necessarily. No, not necessarily. It doesn't have to go into T-bills. It could go into a reverse repo given by a market participant backed by a 2-year or a 5-year security. It doesn't necessarily have to go into T-bills. A 30-day repo creates a 30-day money market security, even if it's secured by a 10-year treasury. Which is a source of funding that would not otherwise be available by treasuries, creates more incremental funding for other risk assets. Yeah. If there was a lack of funding for other risk assets, there wouldn't be a reverse repo. There wouldn't be anything in there because there'd be more money in the market. My view is as long as the RRP is in the 300 400 billion, there would be an ample liquidity backstop that should support risk assets. Well, the Fed is hoping to stay in what is called an ample reserves regime. Ample means that the Fed can just manage the interest rate and it doesn't have to manage the level of reserves at the same time. So it shouldn't really, I don't know that you'd see a change in liquidity at that point in time. I think liquidity is what it is. I don't know that this is, I don't know that I would say that it would support risk assets. Even if there are deteriorating fundamentals, it doesn't matter how much liquidity there is. It doesn't necessarily mean that the world is falling off a cliff, but there's so much liquidity, markets will go up. That's not what it means. When there's excess liquidity, it usually looks to find a home, unless there's a reason not to go into a certain home, like a fundamentally weak economy. And with the Fed hinting at reducing balance sheet runoff, plus $6 trillion of money market funds, I just cannot see a bear case for stocks. That's assuming that I'm going to go ahead and buy stocks no matter what is going on just because I have money. I wouldn't make that bet. I wouldn't make that bet at all. There's no shortage of money in the world at all, and risky assets go down. Markets go down. There's no shortage of funding out there. No, I wouldn't make that. I wouldn't make that. You're making it all about liquidity, and because liquidity exists, prices can't go down because there's all this liquidity. Liquidity just can move into safe assets and stay there, and that's what's been going on with the money market funds. There's $6 trillion in there, but there's nothing about that says it belongs to the equity market. I hear that a lot. There's a lot of money on the sidelines. Maybe who says the money market funds are the sidelines? Maybe that's the home. Maybe that money is in the home it wants to be in. Maybe it wants to be in money market funds, and those aren't sidelines. It's its own game with its own field and its own players. I don't know that I would use that argument. And the liquidity-based argument is great when you have very low interest rates. If you have low rates, then being in fixed income doesn't really pay. You got to find some place to go. But right now, fixed income and duration, that's the game to play, I think, for the next year. 2 companies using a financial modeling course, but publicly traded, correct. I assume the course is just as relevant for analysts working on private equity deals. Yeah, just a different multiple. Private equities would look at them in a different way in terms of the amount of cash flow that it can generate, because it's going to bring a lot of debt to the deal, and it wants to make sure that the company it's buying can afford that level of debt. So cash flow becomes extremely important. Sorry about all this clicking going on, but I've got positions that are executing in the background, so we'll continue to hear these little clicks. If they get annoying, I'll just turn off the system. Please add yield curve trading strategies and applied series. I cannot do that. Yield curve trading strategies is a level 3 reading in the CFA program, and I have a non-compete. I can't just go and start publishing CFA stuff for everybody to see. It is in the level 3 CFA curriculum. You can buy just the section that has fixed income, and it is in there. Thank you for posting a new video about your positions. The sound volume is pretty low. No, it's not. Unrelated to market outlook, how do you actually execute a carry trade? If you go into portfolio construction in the applied level, there is a carry trade in there that I do right on the screen for you. Do you think you're too early for the copper trade? Probably. Copper price heavily dependent on the Chinese economy. Chinese slowdown won't support higher copper prices for long. This is not new. This slowdown is not new. This slowdown has been in China for a number of years now. This is not new. I wouldn't say that with a slowdown coming. They have been in this phase for several years now. So no, I don't know that it would bother me too much. Although there are elevated inventories of copper at the Shanghai Exchange, there are very low levels of copper in New York, or in the NIBOT warehouse. I think that's what it is. And on the U.S. side, let's just say the U.S. side. So we're already there. Just because maybe the financial media is starting to look at it and you're hearing more about it, we think it's new, but it's been there for quite some time. Payoff of the recent banks play. Using BMO as an example, you've set up a covered call, so you'll earn the premium as long as it doesn't go above 118. Correct. But then you're also selling out the money puts, meaning you think the stock will stay above 110. I'm selling out the money puts because I don't mind it being put to me. I'm not selling out the money puts because I think it'll stay above 110. I'm looking to get more of it, and I'll buy it at 110 or lower. I'll buy it, so why not sell a put at 110? If it drops below 110, I'm perfectly happy taking those shares. Perfectly happy taking them. So I'm not selling the puts hoping that they stay above 110. I'm indifferent. If it stays above 110, great. I'll keep the premium. If it goes below 110, great. I bought it for less than 110 and I wanted it anyways. If it goes above 118, great. I bought it at a much lower price and I get the premium on the call and I get the capital gain at the same. Heads I win, tails I win, no coin flip I win. I win no matter what. Will financial modeling course be helpful for building models for Indian companies? It will be useful for building a model for any publicly traded company. Like whatever you do can just be exactly replicated. Well, I wouldn't say exactly replicated, but the process and the setting up of it and can be replicated. But you're going to have to figure out what drives revenue for the company you're looking at. You're going to have to figure out the relationship of the balance sheet items to revenue items. You're going to have to figure out its debt schedule on your own. I'll show you how to do a debt schedule, but that doesn't mean it can be every company's exactly the same. So no, not exactly the same, but highly transferable skills from one company to the next. Is the economics taught in the CFA curriculum is enough for finance? I'm not sure what that means. Even when you want to achieve mastery in finance, like a deep understanding of studying practice, or do I have to read more? Stop reading. Okay, listen. Read and learn, and then join the real world. There's only you can only read for so long and learn for so long before you actually have to do something. You're never going to become a great swimmer by reading books on the physics of buoyancy. And about reading books about the swimming style and about the type of stroke. And you got to jump in the pool. You got to jump in the water. Jump in the market. Don't worry about reading anymore. You understand what's going on here. You can look at a balance sheet. You know what these things mean. You can read a 10K. You know what they mean. You may not know exactly what you're doing at every minute, but after you get through one 10K, you do the next one, you'll know more than you did the first time. Then do the next, then the next, then the next, then the next, and before you know it, you're an expert. You're never going to be an expert reading books. There is a limit to how many books you should read, how many courses you should take, how many classes you should take, how many degrees you should have. There is a limit to that. If you've got your basis down, if you got a good base of understanding, jump in the water. Just jump right in. Difference between a U.S. company's annual reports and an Indian company. Couldn't tell you. I've never analyzed an Indian company. Ask Serify to make bug fixes to the app. You can do that. You don't need me to do that. You can do that. What are your views on Goldman Sachs? Already did that. How do you know off the top what is the methodology for consumer confidence? It is a survey. Is it an average or median? Oh, I see. I haven't really looked into it, so I don't know. How can I be a really good trader? Jump right in. Start and experience. You're never going to be a good trader on day one. No one is. You will be a product of whatever market you happen to have. If you have a bull market, you'll make money. And you'll confuse that for brains, and you'll think, I got this all figured out. I should do some videos on TikTok. I mean, I got a good 3-4 months experience with the market, and I've made money. I got it all figured out. I don't know why everyone thinks it's so hard. You will be a product of the market you start in, right? So you just jump right in. Where to start from scratch? Yep, just jump right in. Lots of trading books written by different authors. Have you gone? No. Once a strategy is written in a book, it no longer works. You're the last trade to make money on. So if I'm doing something that really works, I'm not telling you, because I don't want you doing it, because you're going to ruin it. If I tell everybody, you're just going to ruin it, and the opportunity will disappear. So I'm not telling you anything. When it no longer works, I'll tell you how I made money, and I'll sell it to you in a book, because I can't make money with the trade anymore, but I can certainly make money on you. You're the trade. You're the trade. Oh, we see a lot of experts come to different news channels and give their opinions. Are they worth listening to? Or are they just fools? Nobody's a fool. They're not fools. You'll find that if you listen to 10 experts, you'll get, a whole bunch of different opinions. So a couple of them will be in the same neighborhood. One will say this is a buy. One says it's a sell. One says it's a hold. One says it's going to 1,000. The others say it's going to 10. And they've all got their reasons for saying what they say. The future is unknowable. Nobody knows. Nobody knows. I've said that so many times. Where do you think the market will be at the end of the year? Nobody knows. It's all just a bunch of guesses. And thousands of people make guesses, and some of them are going to be right purely by random, thereby making them look like they know what they're talking about. But it's all a bunch of educated guesses based on assumptions they make about what they think is going to happen. And at any given time, probably 95% of the people are wrong on economic forecasts. At any point in time. That doesn't mean you're 95% wrong all the time. It just means on any one number, 95% are usually wrong. That's the game of forecasting, is that you're trying to predict something that is unpredictable. It is unknowable. I don't know where the market's going to end at the end of the year. I don't know where it's going to end today. Haven't got a clue. And neither does anybody else. No one knows. No one knows. So what is worth listening to is their logic, because they may have a point where you say, oh, I didn't consider that. Does that change my mind? Possible consumer feels that they are healthier than they actually are. This seems to be evidenced by higher spending than income and higher consumer confidence despite negative outlooks from key discretionary companies as Home Depot and Lowe's. Well, I think buy now, pay later gives you a sense of greater purchasing power. And credit cards have always given you that sense of greater purchasing power. Um, the U.S. is very particular, high marginal propensity to consume, a high need to compete with your neighbors, high level of visible consumption, not just consumption for your own needs, but it's got to be conspicuous. What's the point of having an expensive shirt if nobody can see you in it, right? So there's just a lot of buying that goes on, not necessarily for its own sake, but because of the value the person derives from other people seeing them with something they don't have. And I think that's driven a lot by media, by Instagram, by advertising, by the marketing world that says your life is not as beautiful as other people's lives because you don't have this thing. You should go get this thing right now. How do you balance your view of short-term U.S. strength and long peso? Do you reduce the long? Not really. Not really. The peso outperformed the U.S. dollar for a number of years while the U.S. dollar was gaining strength. Where are we on the peso right now? 1990. Yeah, I'm watching the 20 level. If it breaks the 20 and it closes above 20, it could run to 20.5 or 21. I'd be very interested there. If it can hold below 20, that gets interesting as well. It's that gap between 20 and 20.5 I don't want to be stuck in. What does the 757 billion treasury figure means? It means that's how much money they have. 757 billion. Are SOFR 3 rates purely derived from Fed funds futures? Yeah, it would be very, very close because SOFR with a 3-month rate, if you're looking at the forward curve, those are secured. That's a secured overnight funding rate. So they're secured by treasuries. So it's kind of like a proxy for a treasury, is that if I'm securing a loan with a treasury, I should be borrowing at the same rate as the government. Right? So that's all that is, because there should be no credit risk in that trade. Additional credit default spreads priced in. I don't want to say no, but it would be minimal, 2-3 basis points if because it is secured by a treasury. To get new position, I just need to buy the portfolio construction. No. To get any module, you must have the applied level. Now, there have been some requests to break it out as a separate module with a recurring fee that you don't need to buy the applied level at all to get it. I am hesitant on that. I've made no decision on that at this point in time. I'm hesitant because I don't want it to turn into a thing where people are watching it just to outsource their thinking and say, I'm just going to copy what he does. I don't know yet, but no, I'd say at this point in time, you must be an applied level subscriber. How can we predict if market has already priced in interest rate cuts? Well, you don't have to predict. Do you know? You just look at the Fed funds futures, it's pricing in 190 basis points of cuts. So I would say, do you know how many basis points Fed fund futures are pricing? And if you say 190, so does everybody. Which means it's in the price of the market. So does everybody. If you look at a piece of information and other people can see that piece of information, it means it's already in the price. The interpretation of it may be wrong. The belief in it may be wrong, but it is already in the price. Whatever it is, whatever interpretation it is already in the price. It's not as if you come across Fed funds futures say 190 basis points. The market doesn't even know about this yet. Yes, they do. Yes, they do. Unless the CEO pulls you aside in the corner of a room and says, listen, don't tell anyone, but then unless that happens, everybody already knows it, right? A question about the applied series. For Muslims, futures trading or options trading is not entirely permissible due to the speculation involved and because there's no actual possession of the underlying to make the trade. Whereas for a stock, I actually become part owner in the company. Do you think if I were to get the applied series, there would be enough value for me to be able to become... Yeah, the sector studies. If you want to become a better retail investor, you number one, know what the hell you're investing in. That's the sector studies. That is the big centerpiece of the applied level, is the sector studies. And then once I layer on the financial modeling, these are all the tools you need to determine on your own whether or not you're interested in buying a stock. Period. Right? And yeah, so yeah, just the sector studies alone. Absolutely. Okay. Looking to simplify my portfolio and allocate a large portion of passive ETFs inside a TFSA. I have a long time horizon and risk tolerance and ability to push through volatility. Would you recommend a mix of ETFs to track S&P 500, NASDAQ, long bonds? You got 25 years. I would forego the S&P. I'd go for the NASDAQ, and I would probably take somewhere around the middle of the curve to the longer end, the 10-year. I don't know that I'd go all the way out to a 25 or 30-year. Yeah, I'd probably stick with a 10-year. And if the market is questionable, if we feel we're at an equity top, I would then extend my duration from the 10-year out to the 30-year in anticipation of rates dropping. So in a cycle like this, right, equities will be good. You want a bond allocation here, but I'd go with a lower duration like a 10-year. So that as rates go up, this 10-year will move down in price, but it'll have a lower duration than, let's say, a 30-year. Once you get up here and you say, okay, well, I think it's time to rebalance. Equities are starting to look iffy. Let me lower my equity position. This is where I would then extend duration, and I'd go out to a TLT at that point and get longer duration to ride this thing on the way down. I just wouldn't want to ride TLT on the way up. I mean, it was 165 before the rate hiking cycle, and it went all the way down to 85 at one point. How you calculate rate cut probability weightings? They're given in FedWatch tool. Just type in Google FedWatch tool, and you'll see it with CME, and you'll get to it. Difference between GDP per and GDP second estimate and annualized GDP per what? I think you mean per capita. GDP per capita is just take GDP and divided by the population. There's GDP per capita, that's all. Second estimate just means this is all survey-based and sample-based, right? You'll get GDP, our first look at GDP, 3.2%. There'll be a second look 30 days later and a final look 30 days after that. So you get an advanced, you get a second estimate, which I think is called a, is this called a preliminary, advanced, and final? I forget the names of them, but there are 3 looks at GDP. The second estimate just has better data, and it refines the first estimate we've had. It comes closer to a more real number, or what comes closer to what is believed to be the real number. Responding to answer my question about determining the accuracy of the 4P. Oh, okay, we're in a conversation here that I don't want to be in. I feel I've answered this question 4 times now. You're not going to let it go. I think I know where you're going with this. Think about it this way, and this will be the last time I answer this one. Let's say we have a market at 5,600. We have 2 markets at 5,600. This one's got a 22 times earning. This one has an 18 times earnings, and we can look at what the EPS estimate is, right, on both of these. We can look at what and then we can look out and see actual, and we can say, hey, they were pretty good. The multiple must be right. Which one? Which one? What you're doing is you're taking, you have price divided by earnings, and you're saying, well, if the denominator is accurate, the numerator must be accurate. How do you know? Like you're combining 2 things in one by looking at a numerator and denominator and making the argument that, well, if the denominator is precise, the numerator must be precise, but you don't know. I mean, you don't know. So there's no way to know whether or not it was accurate by looking at what any kind of future thing is going to be. Whatever. The only test I think you would have is, no matter what multiple you have, was it worth the price? Only if the market went up. So you buy at 22, market went up, and you say, okay, well, that was worth it. You buy at 18, market went up, you say, okay, well, that was worth it. You buy at 14 multiple, market goes down, you go, well, that was wrong. What makes a 14 more wrong than a 22? I know what you're trying to get to. You're trying to figure out if there's any way that we can determine, based on observation, whether or not the current multiple on the market is correct. You can't do it by looking at how accurate estimates have been, because all that will tell you is that we're pretty good at getting the denominator right, but it's the numerator, right? So that is the end of that. I don't know why you're so heavily focused on this one. Maybe you're writing a paper for finance, or maybe it's your thesis or something like that, and you're trying to get somewhere on that. But as a hobby question, it's a little much. Time to move on. Give me something new. I'm an engineer, not a finance guy. Sounds like McCoy. Damn it, Jim, I'm a doctor, not an engineer. Damn it, Mark, I'm an engineer, not a finance guy. You mentioned we should maintain theta, market value times 0.001. Not maintain, start there. Until you can manage that, then move it to a 2. Is this the same as theta found on the portfolio? Yes, it is. My account has market value 117, portfolio page SPX delta negative 116, Vega 2060, theta negative 92. 117, and then you multiply it by 0.001, 117, you're at 92. There you go. You're well within the 0.001. In fact, you can keep selling puts until your theta gets to 117. Then I would say hang out there for a while. Not that you're at your limit, but get comfortable with managing a portfolio of short options with that. And if you can manage that, then slowly move this higher. If you want to move it to 0.002, then you would have 234. Then you move your theta up to 234. And when you get comfortable playing there, managing a portfolio of short options there, move it up. But don't go crazy on day one thinking, wow, this is a lot of free money. It is not. It's only free money if it works, right? Do we have much more to go here? Not much more. Okay. How do you see the potential mid to long-term return of the TLT trade for a European investor? I think it goes up. I think we're heading into a certain rate cutting cycle. TLT will perform. It is a pure duration trade. Currently, every gain in TLT is counteracted by a weaker U.S. Yeah, well, that is the issue with having currency exposure wrapped up in the performance of the asset. Mid to long term, I see the ECB cutting rates at least as much as the Fed, and I also see the U.S. economy outperforming Europe, which should favor USD, which means the trade should still work well under these assumptions. Currencies are notoriously difficult to forecast. Notoriously difficult to forecast. So I don't do it. I don't engage in it. What you can do to avoid a lot of the U.S. risk in TLT is do a synthetic. So you can go out to January of 2026 and you can, let's say, sell, we'll say $100 put, and you can buy $100 call. It'll cost you something because the forward curve is upward sloping because interest rates are high enough. But you could do this, and it require your margin. You can use euro for your margin requirement on your short put, and because of this, the present value of all the dividends will be in the price of this, and you will put out $0 to get this done. $0. So the only US dollar risk you have is when you're in gains or losses. That's the only US dollar exposure that you have because you've done it with a synthetic. Okay. Every company adopt IFRS or US GAAP. Which would you? Oh, I answered that in the Sunday Q&A. I'd say IFRS. Do you think Canada will go back close to zero as well to lower the debt and stimulate a stagnant economy? I think they'll keep cutting rates until they see some performance. I don't know. I don't know about zero. I think they'd be less willing to go to zero than the Fed would. Could the back end of the U.S. curve move higher as Fed cuts rates, driving TLT further down? It could. Anything could happen. Nobody knows what's going to happen. Could that happen? Sure, it could happen. I would put less probability on that happening than the other way around. I think that the long end of the curve would drop as rates would drop, but that doesn't mean it'll be monotonically. Monotonically means that as short rates drop, the long end of the curve just drops. You could get the short rate dropping and the long end doing this, as this comes down, the long end of the curve comes down, but it doesn't mean in one direction, right? So sure, it could. Sure. I think what you're asking is, does this trade have risk? Yeah, every single trade has risk. This is the game we play. There is always risk. No risk, no return. Why does a curve on inverting? Okay, I already answered that. Purchase the applied level, completing level 3. Position videos are locked in the applied level. For me, it's only purchase. Okay, I already explained what's going to happen there. 6.26 is the money markets where, and how much is the rest? I don't know. Some of it could be in equities, some in bonds, some in real estate, some in commodities, private equity, venture capital, coins, stamps, artwork, wine. Look around you. See all those assets everywhere? That's where everything is. Is in everything physical you can see, and every security that exists anywhere in the world. I struggle with the pricing construction. Okay, I already answered this one for you. It is a pure pass-through security. TLT has no extra valuation layer to it whatsoever, and it's an ETF, which means you have a sponsor for the ETF and you have what are called authorized participants. And there is a net asset value to the stock. And let's say it looks like this, and TLT gets too high above its net asset value. The authorized participants will step in and arbitrage that away. And if it gets too low, they'll step in and arbitrage that away. So TLT will hug very close to its net asset value. If Trump wins, he will get lower rates quickly. Perhaps replace Powell. Your tone in this video has shifted a lot. I don't think so. And now you're referring more to the currency and possible tariffs if Trump wins. Well, he wants to do all of that stuff. I mean, he wants all of it. And I said in the video, he cannot have it all. He wants this and he wants this. Those two things are at odds. If you go back and listen to that part of the video, I said those two things are at odds. He can't have both of those. You cannot have tariffs and expect the Fed to lower rates and get a lower U.S. dollar all at the same time. You can't get that done. So he's going to have to give up on some things. So I don't know that my tone has shifted, in as much as I'm now saying, based on everything he's saying, he's going to have to make trade-offs, which maybe I didn't say he had to make trade-offs before. Don't follow Canadian data that much. Q2 GDP really wasn't that good of a print on the surface. It seemed to be very good if you look under the hood, not so much. Didn't calculate the data myself based on RBCs. Now 80% of GDP growth came from government spending. Yeah, as it has for quite some time. You're right on that. But who cares, right? As an investor in the marketplace, who do you care? Who cares who's paying the bill? Let's say that you have a restaurant. And you have an incredible Friday night every Friday night because a whole bunch of people receive their welfare checks and they come in and they spend it in your restaurant. What do you care? What do you care who's paying the bill as long as they're paying the bill and it's going in your cash register? Let's say every Saturday night everybody pays with a credit card and you say, all my sales are debt driven. Who cares? They're still your sales, right? So the government is doing all of this stuff. Who cares? As an investor, we don't really care how our companies are making their money. As an individual in the economy, we really care because we're going to get the tax bill at some point. But if a government is spending money, all I care about is who they're spending money with. Who's receiving that money? So you're right, it is kind of unsustainable in that sense if we're looking out long term. But for the quarter itself, I don't think it really matters. The government did it. It's I think part of the profile of this government to become bigger, to become a bigger part of the economy. And I believe the NDP are really dragging them that way. By the way, speaking of that, I was at my dentist the other day, and because I'm getting impressions done on my teeth. I'm sitting in a chair right here. Here's the window, and there's a woman standing here. And the person behind the counter was talking about the new dental plan and saying, oh, you would qualify for a discount. Your household income is $190,000, so yes, you'd be covered by the plan. The taxpayer will help pay for some of your dentist work because you're only making $190 household income. What a ridiculous state of affairs when the government feels they have to prop up and help somebody out with a $190,000 household income and pay their dental bill. I mean, come on. This is how ridiculous we are. So 80% of growth coming from the government? Yeah, I can believe that. Let's see. Okay, on the day of NVIDIA earnings release, I sold 0-day to expiration SPY options. Not telling me either calls or puts. Market closing time, my 20 delta options still had a lot of value. Even seconds before 16:15 did not decay and were actually increasing in value. Okay, let's break this down. We don't know if they're calls or puts, but they're 20 delta. So whatever it is you sold out of the money, whether they be calls or puts. 0-day to expiration. So at 6:15 p.m. the game is over. However, NVIDIA didn't report till 4:30, and options have until 8 p.m. That evening to issue assignment. So there could have been value at 4:15 only on the basis that you have till 8 o'clock that night to deliver. Now, I don't use the 0-day to expiration options, but I know that SPY trades all through the night. So SPY is, I believe it's almost a 24-hour ETF. You can trade it at 9 o'clock, 10 o'clock, 11, 12, 1, 2, all through the night. So there might be a different time for settlement. You'd have to look that up. I don't know the answer to that. That sort of goes with what I've said in the past is, try not to trade anything you don't understand. And if you are trading 0-day to expiration options, it is worth at least looking at the rules for them to determine what the cutoff time is. Deficit is the net fiscal transfer into the private sector. Ooh, right away, this is sounding like modern monetary theory, which is a widely debunked theory. I think only a few academics cling to it, and those are academics that really want government positions in democratic administrations. It's more to give cover to politicians to keep issuing debt, but I hope that's not what this is, but it is out of the gate sounding like modern monetary theory. I do not agree with this fear-mongering about, there we are, we're going further into it, fear-mongering about the debt. I guess the confusion, well, there is confusion here, but it's a matter of, which side of the argument you're standing on. Proponents of modern monetary theory think everyone else is confused, and those who understand that this is, well, from my side of the theory, a nonsense theory, think you're the one that's confused. So we'll take the word confusion, but from my vantage point, I'm seeing the confusion on your side. Confusion stems from considering a sovereign nation like a corporation. The IR do not put any pressure to anything. The interest rate do not put any pressure to... And what? Oh, come on, man. So what you're saying is that even if the interest rate were 30%, that would be no issue at all for the government. No issue at all for the taxpayer. Even if 50% of the debt is held by, let's say, China, Japan, Germany, France. Let's say it's all held by outsiders. This 30%, which is a transfer outside of the country, you would say, oh, that's meaningless. You don't know that first of all, you don't know that the deficit is a transfer into the domestic private sector. Some of that could be going to the rest of the world, right? So you don't know that it's going into the domestic private sector. These are simplifying assumptions that modern monetary theory wants to make because it cannot have you thinking too critically about this. It's not a serious theory. This is not a gold standard anymore. What does that have to do with modern monetary theory? I mean, you could say that for any theory. What specifically does that have to do with modern monetary theory? I like your analysis when it comes to macro, you have it backwards. Says the somebody else out there to somebody with a PhD in economics. I've got it backwards. No, I don't think so. It is like an atheist saying if God did not exist, man would have to create it. And a religious person coming along and say, you got it backwards. God created man. I mean, it depends on what side of the religion you're standing on, right? So a better way to say it is that when it comes to macro, it is my belief that you have it backwards. But you're writing it out as a statement of fact. When it comes to macro, you have it backwards. That's not a statement of fact. It's not a modern monetary theory. The T is theory. It's not modern monetary fact. It's modern monetary theory. It's just a theory. I'm not liberal. You don't have to be liberal to buy into modern monetary theory, but it does give liberals cover for their tax and spend policies. I don't follow labels. Take a look at the Treasury statements. For what? I mean, just tell me, take a look at the Treasury. What am I supposed to see there? Aren't you supposed to tell me what I'm supposed to see there if you're putting out statements to defend your position? Shouldn't you tell me what I expect to see? You're saying, go look at it. Okay, I have looked at them, and what? But what in it suddenly backs up this crazy theory? It's almost as crazy as saying there are 117 genders. It's almost as crazy as that, and modern monetary theory, I think, belongs in that category. The idea that that the deficit doesn't matter as long as it's not inflationary, that the deficit simply doesn't matter because governments can either print money or tax their own people. Tax their own people. You got to pay for it. Like, this debt doesn't disappear. You've got to pay for it, and you've got to pay the interest on it. If you are transferring all of that money into your own domestic economy and taxing it at 100%, then deficits don't mean anything. At that point, only at that point, do deficits not mean anything. If you get a coupon payment from a bond and it's taxed at 100%, you're right. Deficits mean nothing. You can run trillion-dollar deficits from here to eternity as long as it stays in the domestic economy and it's taxed at 100%. Then those who do not receive the benefit of this social transfer are not expected to pick up the tab for it at the end of the day with higher tax rates. Pay your fair share. If you believe this, if you truly believe this, let's say that your friends have a business that's not doing too well. Why not just head in there with your credit card and just spend a bunch of money on your credit card with the argument that it is a net transfer to somebody else? Your credit card statement will come due, and you can tell the credit card company, hey, take a look at the Treasury statements, both daily and monthly. It's not going to get you anywhere. To pay that off, you have to go back to the place that you net transferred into and ask them for a net transfer back. Now you can say, well, that's exactly what the government does, and I agree. As long as the tax is 100% on anything that was transferred in and everything stayed in the domestic economy, you're right. Deficits don't mean anything, and modern monetary theory becomes modern monetary fact. But that is not the case. It is not the case that 100% of the transfer stays in the domestic economy. It is not the case that the tax rate is 100%. So, no. It also doesn't work with different central banks holding significant U.S. debt. It doesn't work with me as a Canadian in my RSP holding U.S. Treasuries. There is a tax treaty between the U.S. and Canada which says that if I'm holding U.S. Treasuries in my RSP, there is no tax withholding from the U.S. government. So suddenly that is not a net wealth transfer into the domestic economy, and it is taxed at 0%. That is purely just a leakage. Modern monetary theory makes simplifying assumptions. It doesn't want you thinking too critically about it. So it says things like, take a look at the Treasury statement. And without telling you exactly what you're looking for or what the evidence you're looking for is or what in that statement would even support what it is that you're discussing. I can respect that you have a different opinion than me, but try not to state your theory in terms of fact that I'm wrong. You call it fear-mongering about debt. It's not fear-mongering. Not fear-mongering at all. You're saying that the confusion, that we're confused because we don't agree with what you agree with. Your statement that I have it backwards, period, end of sentence. No, it's. I think if you critically assess modern monetary theory, you will find that it quickly falls apart. And that's it.